talking macro, and macro, it's been a crazy year in 2023. We've had the second and third largest bank failures. We narrowly avoided default with the debt ceiling. I don't know if you guys remember that. Our debt was downgraded for the first time since 2011. And we just also narrowly avoided a government shutdown, and we still got a quarter left. Stanley Druckenmiller says it is the most difficult macro environment to forecast in his entire 40 years. So I'm going to ask these people the impossible. Hardcore Bitcoiners say the price doesn't matter, but I would say miners are like, the hell with that. The price does matter. And so let's talk about just kind of more short-term to medium-term predictions leading up into the halving. All right, so Jamie Dimon says that interest rates can go to 7.5%. Ray Dalio says that we're headed towards a debt crisis. Maybe throw it to Lyn first. Just what's kind of your base case for the leading up into the halving? I know it's a really hard question, and you can't have a crystal ball. But what's kind of your base case of what to expect?
So when I've kind of like reviewed different models or correlations with what contributes to Bitcoin price action, and like you said, basically, in one sense, we want to make it so the price doesn't matter. But when you're doing a lot of capex or when you're managing a portfolio, obviously price matters in various time frames, even if you don't really want to be a trader. And there's obviously been a lot of focus on the halving over time. So historically, halving's on the 4-year cycle, and the bull markets generally come after the halving. But there are some things that have historically been more correlated with Bitcoin price than the halving. And the one that kind of stands out from my research is global liquidity conditions, which is basically a fancy way of saying global broad money supply in dollar terms, right? So there's two main components of that. So there's one is how much money printing or bank lending is happening on a global basis, especially among the top 10 currencies or so. And then the second major factor there would be is the dollar strengthening markedly compared to other major currencies. So generally, Bitcoin is challenged in a low liquidity environment and doing well in a high liquidity environment. And in terms of both correlation and causation, it makes sense because as a finite supply money, you'd expect it to do pretty well when you have supply inflation of global currency. Which is basically a predecessor to CPI and a more direct link to inflation than just the lagging effects of prices. And then in a correlate variable, so the challenge is that most risk assets in generally do better in rising liquidity environments versus falling liquidity environments. That's not really rocket science. But Bitcoin, from what I've looked, is more correlated with liquidity than most other assets are, because other things that are more noise inducing, like things like earnings or things being defensive assets, like perhaps gold, where you might go into it, ironically, on a lower liquidity environment compared to stocks. So Bitcoin being both perceived as a risk-on asset with no earnings and finite supply has historically, at least in the kind of the second half of its life cycle, where it's been big enough to be a macro asset, has been highly correlated with global liquidity. And I think that's one of the key things you have to look at going forward. And I think a lot of the metrics point towards kind of continued consolidation for a little while, at least in that liquidity indicator. And then as you look out a couple years, I would expect another sharply rising liquidity cycle, because it's only so long that you can maintain this sort of like poor liquidity environment before things break, things get rough, things decelerate, and then you have another round of higher liquidity.
Yeah, and Mike, I just remember back in March 2020, you were kind of a contraindicator. There's a lot of panic going on, and you were like, all right, this is actually a time where things are probably going to rise when everyone's panicking. Yeah, exactly. And now I hear the same thing from you, where you're like, sentiment is pretty bad right now. And this is how all bull markets start. And so I thought that was interesting because it's kind of against consensus, I would say, right now. So can you kind of explain your thinking around that?
Yeah, look, the sentiment right now in Bitcoin and Bitcoin mining is about as bad as I've ever seen it. And what's so funny about that is Bitcoin's up like 65 or almost 70% year to date. But if you talk to most people in the space, you'd think that it was down 60%. And so that sentiment, I saw it in December of last year. I remember sitting in a IRA's board meeting, and I literally said, I think we're at the risk of getting too negative right at the bottom. And I think a lot of people are about to do that again right now in Bitcoin mining. I don't disagree with anything that Lyn said, like the M2 figures, all that stuff is real, but there's also just something going on with Bitcoin that's different than most other assets. And Bitcoin is monetizing in a way that no other asset in human history has monetized before. And so I feel like it's possible that Bitcoin could behave differently. And if you look at the last couple cycles, Bitcoin tends to retrace back a significant percentage of the drawdown. So when Bitcoin draws down 80, 85%, before the next halving, Bitcoin typically retraces like 75 or 80% of that. It hasn't done that this cycle. And at $27,000, right, like most miners are not going to be profitable after the halving. I'd say the vast majority of miners, I was talking to somebody on the side right now who said essentially doing a lot of analysis on this, there's like 1 or 2 public miners that are actually economic post-halving at a $27,000 Bitcoin price. So if you really get a $27,000 or $25,000 Bitcoin price by April of next year, then a significant portion of the existing hash is going to be uneconomic. And so a lot of our forecasts are going to be wrong. As it relates to the overall macro, though, I just don't think it's as bad as people think. The fiscal deficit we're running in this country is like 8%. It's probably going to 20%. There's so much liquidity. That's why every time you go to a restaurant, it's packed. Like CNBC is telling you the world's going to end and yields are rising and dollars rising, but everywhere you go, the plane's packed, the hotels are packed. That could change, right? That could change between now and the end of the year. That could change in the first quarter, maybe. But I just think there's so much liquidity sloshing around after the pandemic response, and just fiscal policy going forward is going to overwhelm any monetary policy. So you can raise rates as much as you want, but there's still going to be too much money chasing too few hard assets. And that's why I like the mining space, right? So I'm an investor in a number of the mining companies in this room via my fund and directly. And I think miners are undervalued. I think if you look at them as hard asset businesses, if you own the land, you own the buildings, you own the data centers, you own the electrical infrastructure, you could literally stop mining Bitcoin and sell all of those assets. In some cases, you'd get the current market cap. So you're sort of protected like Buffett style on the downside if you just do a margin of safety analysis around the hard assets, but you also have this exposure to the exponential upside of Bitcoin itself. So people are forgetting that right now because sentiment is negative, but in 2025, when Bitcoin's ripping again, all the miners that survive this cycle will be 5 or 10x higher. It'll happen every single time. You don't even have to be a genius to do this, although I do prefer to choose the miners that are shareholder friendly, that have good balance sheets and are well run.
Yeah, and I'll definitely pick your brain about some of the mining equities later on. But I'd like to turn to Rapha because, like you brought up, Mike, that Bitcoin could be acting differently. And during the banking crisis in the spring, I would say Bitcoin did act pretty differently. It really ripped when there was a lot of risk out there. And Rapha, you're in a unique position given your role at Swan, where you're having conversations with institutional investors. And I was just wondering, how are they starting to think about Bitcoin portfolio strategies? And what are the kind of conversations that you're hearing in your position?
Yeah, so this morning when Sam came to me and said, well, we have to think about what we're going to talk about. And he said, oh, it's macro. He said, oh, Lyn is going to be there. I said, okay, Lyn can do all the talking. I don't need to say anything. So then we did something else. Sam said, well, we're going to be on a mining conference. Tell me about the things that we've been seeing about mining and mining stocks and how that correlates with Bitcoin. So very quickly, we did some analysis, and it confirmed, I think, some of the things that we all know. So let me first caveat by saying that we don't do any price predictions. That's actually one of the core things of what we have in Swan Research. I just think it's impossible to predict price. It's very hard to predict price in any asset class. I would say in Bitcoin it's impossible because even though the supply is completely programmatic, the demand is anything but programmatic, and it's a nascent asset. It's about to capture a lot of market cap from other assets like real estate, gold, etc. And that's going to take, that can take Bitcoin 100x, 1000x from here. And we don't know if that's going to happen tomorrow, if that's going to happen in 1 year, that's going to happen 10 years from now, right? So, and that could switch very quickly. That being said, so going back to the Bitcoin price. So if you just look historically, right? And if you look what happened in the last 2 halvings, and it's only 2 data points, so who knows what's going to happen. But it's actually pretty interesting to see that we bottom at the same place, we hit the all-time high at the same place, right, in terms of number of blocks to halving. May just be a coincidence. I think, there's a lot of it that it is a coincidence. But by looking at the past, the reality is that we're probably going to go through a period where Bitcoin price is not going to rally significantly after the halving. The average was 5 months after the halvings when price really started to go up, right? Which is, of course, not good for miners in particular. Difficulty also is another thing that, historically has just been keeping going up gradually. There's very low correlation to anything else. The only time that we really saw a significant drop in difficulty was right after China shut down, right? So after that, continue to go up. So again, bad news for miners. So what are the good news? So when you look on a portfolio perspective, because that's a question we get a lot. So should I add mining? A lot of our clients have Bitcoin in their portfolio and they say, okay, should I add mining stocks to my portfolio as well? And the short answer is yes. Not probably for the reasons that a lot of people say. People say, well, it's kind of like a correlated bet to the upside in Bitcoin. And it is a little bit of that. But historically, actually, the correlation between forget all the Bitcoin miners, right, the public miners out there, and you look at, create an equally balanced portfolio, and you look at the returns, they underperform Bitcoin, and they actually have a worse Sharpe ratio than Bitcoin historically, right? But the good news is that they have very low correlation to Bitcoin, which actually means that on a portfolio basis, you adding mining stocks to your portfolio, you can actually increase your Sharpe ratio. A little bit counterintuitive, but it makes sense because on the drawdowns, right, they tend to protect you a little bit. On the upside, you also get a little bit more exposure, so it does make sense. The problem is that you then need to select which assets you're going to do, and it goes back to my first point, is you need to be a little bit of a trader. You need to analyze which stocks you're going to pick, right? And most of our clients are not going to do that, right? So either they buy a little bit of each, right? But that's a separate discussion.
Well, Mike, you invest in mining stocks and mining companies pretty heavily. And so when you're looking at mining companies, how do you separate the cream from the crop? What do you look for as differentiators and to where you want to allocate your capital?
I think it's really hard to do it well, to be honest. Like it's going to be really easy to make money in 2025, but it's also really easy to lose money right now. And you're just talking about the correlations. Well, Bitcoin kind of topped out, I think, around early July this year. Miners didn't top out until July 13th. They actually, a lot of them doubled between late June and mid-July, but since then they've drawn down 60%. So you can imagine having really large exposure to miners, and Bitcoin's actually up over the last 30 or 45 days, and miners are just cratering. I think that's a short-term problem. I think if you really want to do it well, you have to focus on like the very top of the matrix. So the first thing for me is the management team and the leadership actually focused on creating shareholder value? Because the reality in this space, it's an unpopular opinion, most of these companies don't across the full cycle. I think the entire industry collectively destroys quite a bit of shareholder capital, although there are some exceptions. And so I start there, right? Like, is this a management team that's actually trying to generate a return for you as a shareholder, or are they mostly trying to enrich themselves? Then from there, you cascade down to what's your power pricing right across the portfolio? What's your machine efficiency? What's your geographic exposure? How big are you? How fast are you growing? What's the balance sheet look like? If you run out of cash, right, it doesn't matter how good your operations are. I know Russell was just up here and making some fun jokes about that, but a lot of people lost money in core because they had a wonderful asset base, but their balance sheet was too aggressive for that part of the cycle. So my general advice for most people is like not to try to speculate in the space. Like when I think about exposure to Bitcoin, the safest exposure to Bitcoin is Bitcoin in cold storage. The next safest exposure to Bitcoin is Bitcoin with a major regulated tier 1 custodian. The next safest one is probably a fund, like a Grayscale Bitcoin Trust or a BITO. Then maybe MicroStrategy, right? Because in that case, you're just buying an operating business that's servicing debt on a portfolio of Bitcoin. And then way over in the end is levered Bitcoin miners. The funny thing, though, is that the miners that are the least responsible, right? The ones that have the most debt, the ones that are being the most aggressive, if Bitcoin rallies between now and the halving, it'll effectively bail out those firms. And so the highest return miner over the next 12 months might actually be the ones that are most likely to go bankrupt. But again, I wouldn't invest that way. I'd rather buy the miners that are going to be able to hash profitably no matter what the Bitcoin price is. And I think there's only a handful of miners that meet that criteria right now.
A general trend you see, like even if you look at gold miners or like just other kind of traditional mining assets, normally the industry as a whole either destroys capital or makes marginal returns. Like if you look at the gold miner index for like decades, it's abysmal. There's basically almost no positive returns compared to gold, which did way better over multi-decade period. And it generally comes down to that management team in many cases because you've got serial kind of capital destroyers, hype cycles, things that are doing really well for a cycle and then nothing. Whereas it's really in that space, it's historically, you find like success begets more success. Like basically you pick the winners because they're likely to keep winning. It's kind of the Lindy effect in action in the mining space. And I think we're starting, over time, we're seeing more and more of that in the mining realm, the Bitcoin mining realm as well. I mean, obviously, there's less data so far, especially for publicly traded companies and all the transparencies there. But that is something we should expect from the traditional mining, which is basically the long tail of low quality stuff. At most is suitable for a trade in a bull market, but then it destroys capital over the course of a cycle. Whereas a handful of the best management teams, they know when to be conservative when things are frothy. They know when to kind of dig down when when the opportunities leverage themselves, and they always kind of make these longer term multi-cycle decisions versus these shorter term cycles.
Yeah, absolutely. I mean, the management team is so important when you're looking at these companies of deciding where you want to invest. And then the halving's beautiful because it's like a cleansing mechanism, right? If they are inefficient, the halving's going to make them know it pretty quickly. Lyn, I wanted to stay on you just for a second because, this year, one of the tailwinds for miners has been the fact that natural gas prices have fell so heavily, and that's kind of the marginal price setter for energy on electrical grids. And oil has been ripping lately, and so obviously that's going to be a factor for all of these miners. You have kind of been spot on with your energy calls in the last couple of years, and so I would love to hear your thoughts about how you see that playing out kind of over the next year or two.
Well, so of course, and I think a lot of people here would know, but what makes gas very different than oil in this regard is that it's far less fungible. So oil is fairly fungible around the world unless it's uniquely isolated. It's fairly lower cost to transport it compared to get out of the ground. Whereas natural gas, because it's a lot more costly to transport, you either need a pipeline or liquid cooling for long distances. That makes the European gas market and the North American gas market can be completely different, like zip codes in terms of price, because there's a limited capacity to arbitrage that gap. And so given the lack of export capacity you had, North American gas is kind of low. I think the next few months, it's really unclear because we have kind of still decelerating economic indicators. Well, I think a lot of people overstate how much, say, oil is likely to suffer if we do get an outright recession, and that's because they kind of think back to the last two recessions. It's always recency bias. So 2020, obviously, oil went negative in some, futures and things like that because that was the biggest ever oil drop demand ever because it was a unique situation, not a normal recession. And then the one before that was the Great Recession, so one of the largest ever drawdowns in energy usage. Whereas if you look back over the past 50 plus years, there's only been like 5 years where global energy demand has diminished in any way. 3 of those years were in the early 1980s, right after the Volcker spike and the big dollar run that eventually led to the Plaza Accord. And then the other 2 were 2009 and 2020. When you look at recessions like the dot-com recession and other kind of more mild recessions, which again you shouldn't judge just by the equity market, but the actual indicators of the recession, oil is usually kind of choppy, weak for a little bit, and then recovers. And when we look at the tightness in the oil market, when we look at just overall energy kind of constraints, we already see kind of U.S. shale drilling is sort of the leading indicators are not constructive for like a continued growth and rapid supply. I would generally take the over on energy in most cases. I'm going to fade generally, whenever it has a bull run, people start kind of like, thinking it's going to go up to 120 right away. I generally fade those types of calls, but I think it's going to be stickier to the upside. And so I would generally keep taking the over on energy prices on a global basis unless you can find very specific areas where it's stranded. There's other constraints involved, and there's all these unintuitive things. Like you can have Europe with an energy crisis at one point, and then everybody floods the market with it, and then energy prices collapse. So you get these weird gyrations, but I'm going to keep leaning into the kind of the view that energy prices are sticky.
Yeah, and if energy prices are sticky, that's going to affect the break-evens of these mining companies. And Rapha, you did some analysis looking at the break-evens, and can you just give like a little broad overview of kind of what you found with that?
Yeah, so just add one point before that. I think, we talk about management, we talk about technology, but another very important factor for miners, it's cost of capital, right, at the end of the day. And cost of capital is getting more expensive for 2 reasons. The first one is obvious, right, interest rates are higher, but then also it's a sector that it's very hard to go to the market right now. There are a lot of investors that we talk to that don't even want to talk about Bitcoin right now, that traditionally would talk about Bitcoin. So that, of course, increases the cost of capital, right? And I think going into the halving is going to be very important to see who has the best cost of capital and the cheapest cost of capital out there. When we look at the numbers, right, they vary a lot across the different miners, but they're very scary, right? The break-even prices for Bitcoin, they range anywhere from the low 30s, so depending on the assumptions that you make, all the way to the high 90s, right? So that's all over the place. There are definitely some companies that when we look at the break-evens at the current structure that they have right now, you're not going to make it, unfortunately, right? And that goes back to my previous point. I think, selecting the mining stocks that you're going to have in a portfolio, it's a little bit of a trading game. You have to select the right ones, and to do that, you have to look into the companies, you have to do a lot of fundamental analysis, you have to really understand the balance sheets, right? A lot of our clients are just not going to do this. And the reality is, as Mike said, there's no second best. Just buy Bitcoin, put it in cold storage, right? And forget about it. It's probably the best thing you do.
Absolutely. Well, we're already out of time, guys. I could talk to you guys forever up here, but thank you so much for sharing your insights. Rapha, Lyn, Mike, thank you, and thanks for listening, everybody.